All right. Good morning, everybody. We've been in this hurry up and wait mode for 2 days, and I believe we're done with it. Today should be the day that we no longer are in the hurry up and wait regime and we begin to expand. I'm not necessarily putting a directional bias on that expansion, just that the reversals intraday playing against the edges of the previous day's range is likely not the trade that you want to do today. So let's just get that out of the way off the top. Um, yeah, because today is likely the end of the hurry up and wait mode, we have the opportunity to see a liquidity gap trade. This one confounds new traders because, well, there is no gap. They're thinking it's a gap in price, but we're not talking about a price gap. We're talking about a liquidity gap. We are looking for an outsized bar, something on the magnitude of 100x larger than any candle around it, as shown in this picture here. Now, I'm a little picky about how I want to trade these or if I will even trade them. But when we get economic events, and it can happen, in the middle of the day on headlines and news, it can happen on the clock, like 8:30 CPI, PPI, non-farm payrolls. When we get these sort of candles, we can use them for analysis. And if they present correctly, we can use them for trade setups as well. This is an example of what we're looking for. So this was CPI a while back. I don't remember the day, but there was no wick going in the other direction. The candle closed in the upper 25%, and that is the liquidity gap. To close this gap, we would need to come back to where the candle started at 8:30. Now, in this scenario, we never did get that gap closed. But once this candle is closed, you can mark that candle's high and low and mid. You can measure the entire candle and project it higher and lower, 50% and 100%, so that if we do break out and continue to run, we know where we're headed. If we had done that in this picture, that's what we hit up here. On the fade back, we hit the 50% here. So these candles can be used for laying out our trading targets, our levels. They can also provide analysis. This is another gap close example, liquidity gap. No real wick going in the other direction, closed near the upper end of the candle. And we began working our way back. We got the gap closed around 10:30, 11-ish. Here's a downside example, same thing. No real wick going in the other direction, closed in the bottom 25%, little bit of a base, and we began working to get the gap closed around 10:30 or 11 o'clock. So these gap closes take time. We're not looking for an immediate reversal and run right back down and getting them closed. Here's another one. This was also a CPI. We closed in the upper portion, and then we did a little bit of a consolidation with price trapped inside of that wick. Then continued on, put in a base, came back down, got the gap closed around 10:30, 11 o'clock. So we're talking around 2 hours to get this gap closed. That's something to really keep in mind. And as this first example showed, it doesn't have to close the gap, We can use these candles, though, for more than just a trade. We can use them for analysis. This is what I do not want to see if I'm looking for a trade. You can see that there's big wicks on each side. Price closed really close to where it opened. We don't have to go anywhere to close this gap because we're already there. There is no gap. All we have is a really big candle. We can measure that candle, mark its mid, project 50% and 100% above and below. And if price breaks out and goes like it did here, then that measurement is going to be really helpful on, hey, where's it likely to stall out at? And as you can see, that measurement would have worked perfectly if I had drawn it on there. That's where we had stalled. Even on the fade back, the midpoint was fantastic for another stopping point. Same thing here. This is what we do not want to see if we're looking for a trade, but we can still use this for our analysis. Measure it out, project it higher or lower, mark the midpoint out of it. It will provide opportunity and at the very least, insight into what the heck we should be expecting out of the market. Why am I showing you this today? Because I think we're going to get a liquidity gap today. I think we will, but I don't know. Maybe it's a dud and we don't get anything, right? Nobody knows what the market is going to do. All we can do is look at what has happened in the past and make assumptions about what is going to happen in the future. That's it. That's technical analysis 101. So when markets start misbehaving and doing things that aren't normal, technical analysis can get thrown in the trash, because if you're looking for markets to behave the way they have in the past and it's doing something unusual now, then it's not going to behave the way that it has in the past, right? I know newer traders struggle with the idea that we actually don't know 100% what is going to happen next. And I see the questions all the time. Will this go here by Friday? Will this do that? Who the hell knows? Best we can do is lay out the odds, tell you what happened last time, present what it's supposed to do, what we would expect it to do. And if it breaks a level, it opens the next level, and that's what we've run it to. So instead of will it, you want to replace that word with something like can it. Can we get to this level? A little red in Japan, down around 1/4%. Everything else is green. Bitcoin and Bitcoin names are alive and well this morning. Boy, a lot of them this morning moving around. The Dow doing pretty good at 1/4%. Really, everything's around that quarter except the small caps are up more than a half. So just toe the line, get through this data point, and then we'll see what comes out of it from there. We weren't sure, at least I wasn't sure on Monday, if it was going to be the ADP report or not. We knew that this week was hurry up and wait. That I was 100% certain of. I just didn't have 100% certainty on which event we were waiting on. Now I'm convicted it's the ADP report. If I'm wrong, then it'll be tomorrow with the initial jobless claims, but I really just don't see that as being the one. Still, it could be both. So if tomorrow we happen to see additional hedging and the same behavior that we've seen, then we'll know that it's the initial jobless claims. So 8:15 today, we're going to get the ADP employment. That's going to throw people off a little bit. They're used to the 8:30 time frame. We'll see if that has any impact on things. Otherwise, we'll get through that. And by noon today, we're going to pretty much be done with anything that could be coming at us. We got ISM services at 10, and it's Wednesday, so we should have strategic petroleum reserves and crude oil inventories today. They're going to come in at 11:30 today instead of 10:30. Well, it didn't hurt to check. So a little, it's just weird. That's normally a 10:30 event, and ADP is normally an 8:30 event. So the times are just a little off today. Keep your eye on that clock. It's going to really be the best indicator that you have today. Still, once we're done, no, I take that back. We got the president today speaking at 3:30. There is some photo event at 10 a.m., which means there's a chance for him to run his mouth to reporters. And then again at 2:30, he has an announcement. So that just broke our afternoon right there. Markets could do anything at that point. No idea what we could get from this. So moderate risk based on current schedule. That about sums it up. Still, we got to get through the morning session. All right, so we are above zero gamma still. We are above the volatility trigger, and we are IX10 at this point. I know it sounds really complex and sophisticated, but IX10 just means that we are inside the previous day's range for more than one day. Because if it was just one day, we would call it an inside day. Right? So we have this day here, December 1, when it was yesterday, December 2, and we looked back, oh, wow, we're inside of yesterday's range. That's just an inside day. But when we do it yet again for more than that one day, we call it IX10. We as in me. That's what I call it. You can call it Bob's uncle if you want to. I don't care what you call it. If we were IX10 and it was a really narrow range, it would be more insightful, more impactful. But we are inside of a wide range, more than 100 points or near 100 points, it looks like. Maybe not. Maybe it just feels like 100 points. 60, 62 points. Feels like forever. That 62 points is our range. 62 is tight enough. We can see that tight range on the intraday. Markets do not like compression. Just like nature, if you compress the markets for too long, they will explode. There's no bias in that statement. I'm not saying they're going to go up. I'm not saying they're going to go down. I'm saying we can get volatile movement because we stayed compressed too long. If we had stayed compressed inside the November 28 candle, that would have been a real calamity. And if you don't count the wicks, say you're running something like OCR style analysis, one candle reversal, then we are really compressed inside of this 30-point range, 40 points. It's a really tight range. You can see the white line there. It's a 3 or 4 period daily moving average. And as long as we're holding above that, we are bullish. We needed a correction. We had that 5-day run and we paused and we went sideways. Corrections in price can happen in a lot of different ways. I know the easiest way to think of a correction is that we fall back and go the other direction. But that's not the only way that we can correct. You got a correction in time or a correction in price. This was a correction in time. We got here, got a little extended from that 3-day moving average and stalled out. And it gave that 3-period moving average time to catch up to us, which it has done. Now we can push off of that and continue to go to the upside. Just because we can push off of that doesn't mean that we will. Here's another example where we pushed off of it and yeah, well, that didn't work, yo. So we are poised with data and the charts set up for a really nice move to the upside. Really nice. Of course, we have seasonality as a part of this, but if you're going to bring seasonality into it, you really want to dial in your seasonality to what the Fed is doing. When you look back over a 20, 30, 40-year history and you say, oh, look what happened in December, try to separate what the Fed was doing. Was it a Fed cutting cycle? Was it a Fed hiking cycle? Were we on autopilot, or were we in the we'll let you know at the next meeting regime? Because that greatly affects everything. So is December a bullish month? There's an old phrase about data that, a quant can make the data say whatever they want. And when I was in college with psychology, they really hounded us about, being fair and honest when you present the data, so that you didn't manipulate people by its headlines, or, by the statistical outcome, because you can make it say whatever you want. You really can. And it's not lying, it's just straight misdirection and obfuscation. It's a big word early in the morning. So be careful with your data if you're looking back at December's performance, trying to get a feel for what generally happens in December. We are poised for a very large move here. We've got structure, we just corrected. We're not overbought, we're not overextended. We're sitting in the middle of the basketball court ready to make a move, and we got either direction to make that move. 5% in either direction, and we would not be overbought. We would not be oversold. We would not be overextended. We could easily move 5 points from here, 5% from here. I'm still a fan of the upside, but I'm not putting a bias on this. For the upside, we've got a liquidity zone around 6,900. You can see they was front running it. And then we've got another one at 6,950. If we can get through 6,900, we're going to 6,950. If we can get through that, then we're going to 7. If we get above that, we're going to 750. Because I like those 50s. I think we're still running 50s. And really, if we get above 69.50, I'm going to be aiming for 750. But we got to get through 7,000 first. Level by level by level. In the other direction, if we break last Friday's low, if we break Monday's low, then we'll cut the 10, test the 20, get under the 20, and we'll run for that 50. That's 67.50, but it's also the 50-period daily moving average. So I don't care which 50 you want to aim for. They're both in the same spot-ish. 67.41 is, 41s are an old cog line. We don't really use that cog line anymore, but I haven't validated cog lines since the S&P was in the 3,300, 3,500 area. It's been a wee bit. Yeah. I'm not that old. Come on. All right, we do not see additional hedging yet this morning. That calls into question that today is the day that we're going to see the end of the hurry up and wait. Maybe it's tomorrow. Maybe I'm wrong. Maybe it's not ADP. Maybe it's tomorrow's unemployment numbers. But either way, 8:15, we do have employment data coming at us. It is important. It is relevant. It's one of the two features of the Fed's dual mandate. And it will go to the heart of whether or not repricing in a Fed rate cut was the right idea or not. If the market gets the data today and thinks they're not going to get that rate cut, they're going to begin to unwind the rate cut that they've already priced in, and we will go down. That's not a possibility or a maybe. That's exactly what we're going to do. We're going to sell off, very likely down into 66.50 or even 65.50 easily today, if the market reads the ADP as a reason that we won't get our rate cut. Otherwise, if I'm wrong and today is not the end of the hurry up and wait, if that happens to be tomorrow, then the ADR lines that we see here, these two red lines, these are going to be today's buffer. And we still have this week's range to deal with, which is that range right there. We've been in it. We continue to hold in it, and we need to get the heck out of it if we're going to do anything else. GTFO. It really is that simple. Now we're testing the upside, and as we can with any range, we can project a 111 and a 1236 out there to ask, if we were to break out and fail that breakout, where is it likely to fail at? The way I like to phrase this is, if the breakout is going to fail, it's most likely going to do it at the 111. That is the most likely place for the breakout to fail. Even if we get through the 111, we could still make it to the 1236 and then fail. So when we get to the 1236, we want an OCC, opposite candle color. And at that point, we could update the drawing, lay out new levels, and see what the market is going to do at that point. If it's going to reverse, it will happen at one of those two levels. Otherwise, if it doesn't reverse at one of those two levels, then we run it to the upside and we run it till it breaks, because that's what we do. So what I will be doing, if you go to play the reversal today, be very careful, because I don't think it's going to reverse. I think the breakout today sticks and we run it. This is not like yesterday and Monday when we were in hurry up and wait mode and I kept talking about playing the reversal if we get to the edges. I am not talking about playing the reversal if we get to the edges today. Even though that's my favorite trade, yesterday's 111, as you can see, we had yesterday's 111. Beautiful reversal. That was the best trade of the day yesterday. A perfect rejection on yesterday's 111. Right? That's my trade. It's my favorite. It's my baby. I'm not talking about making that trade today. I think if we break out, it's going to stick and we're going to run. But we don't have hedging this morning. And if ADP is the catalyst for the hurry up and wait that we've been waiting for, I expected to see hedging, and we don't have it, which means I might be wrong and it might be tomorrow. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. And price already hit it and is still above it, and that is also bullish. Each one of those things adds to the bias. Then we have this 3.5 day range, and we're sitting at the top end of it. That's also bullish. And is a powerful word, especially when you can apply it to technical analysis and you can say the floor pivot is higher than yesterday and price opened above it and we're at the top of the range and we've got bullish flow and they rolled the call wall out of the way. See how that and just keeps adding to our bias? We can just keep putting in more and more statements of bullishness. R1 68, 66. If we can get above R1, we can aim for R2. If we get an inside day breakout of yesterday's range and we tangle up into 111, that's just going to be slightly above R1. It'd be a nice place to reject and come back in again. If the ADP report today is not the catalyst for this hurry up and wait, then that is very likely the reversal point, R1 or the 111, the 1236, because they line up really nice. It'd also be the ADR half, the red line. We don't have an R1 S1 yet, so we got to let that play out. And we're not overextended from the weekly yet, so we don't have any scenario that we're overbought or anything like that, because we've gone sideways for 3 days. That sideways has developed into a really beautiful range here. Nice distribution pattern. If we were looking for the classic D shape, there it is. We're holding above the point of control. And the higher we run on this distribution, the thinner the footprints are. So, the less resistance we have against that level. From this time frame, we really don't see a lot of sellers up here, right? It's thin compared to what we saw down here with two-sided trading activity. But we're on the weekly, so we're looking at the combination of volume from Monday, Tuesday, and now into Wednesday. We need to see this all by itself and see what happened the last time we got up here. Did we run up and buyers got exhausted and we faded back down? Or did we run up into a bunch of sellers and they hammered it back down? Because those are two entirely different statements. $10-day, 30-minute volume profile in TPO. Hey, look at that. The point of control moved up to our current location. We talked about this over the last few days about having it move up. And now it's there. So cheers for that. But now what? Well, as long as we're holding in this range, we can crisscross back and forth above and below this point of control, and it won't act supportive or resistive. It's more like gravity or a zone, and we can just stay in this zone, winding up more and more and more and more energy. Remember, when we're in a range like this, you don't know you're wrong. If you're long, you're still long. If you're short, you're still short, and you don't know if you're wrong. So more and more and more traders can get into this level, and where do they put their stops? Above and below the range, which is why we get a nice little setup called the raid and the draw, right? This would be the draw where we're drawing everybody in. Then we raid the liquidity on one side and we make the break on the other side. It doesn't feel like a raid and a draw scenario, but it's worth mentioning. TPO lines up well. And at this point, the TPO is still the better of the two profiles. We have some supportive footprints around 6770-ish, but that level's been on our radar for a while. And then below that, 6700. It got real shallow at 6750. Nobody stepped up. So they took a front run on either side. When we were running up towards 6750, they front runned it on the bottom of it. And on the other side of that, that's where they were waiting when they hammered it back down once we broke above it last time. So really shallow around that 6750 area. We do not have a new VPOC for today. We would have, except for this little dip down last night. And while the textbooks will tell you to carry this level forward, I generally don't. I only focus on the ones that haven't been hit. But, on a day like this, where maybe we're looking for a little bit of guidance, you might want to mark that level out. You don't have to mark it as a VPOC because it's not a VPOC anymore, but it is still a POC. Is the point of control from yesterday? I don't have it dialed in perfectly to the tick. I'm not interested in doing that. You do you. If you want to zoom in and get it right down to the nitty gritty, then you do that. 68.41 old school cog line. Really nice distribution this morning. You can see how they came in. As we came up and spent 5 minutes here, 10 minutes, and look at that level of volume. As opposed to, say, yesterday, when buyers were exhausted and we just fell back down. See the difference between those two. Really great example of what I was just talking about. Here, we ran into sellers and we're not falling away yet. Buyers are fighting them. They're duking it out right this minute. Over here, we didn't get that. We just had a rip in price. We ripped up, got a new high on the day. Buyers got exhausted. We fell out, came right back down again. Right. Yeah, you like it. It's just a volume profile. That's it. Nothing fancy. All right, we're still above the 10 week. We're not overbought. We're not overextended. We are just now getting back to Friday's close. That's what this gray line is, right? This is Friday. That's the close. And we're peaking above that level. We've peaked above that level every day this week, right? There's Monday, Tuesday, now Wednesday. This day obviously isn't done yet, but we're more than half done. And so far, we haven't managed to do anything more except maintain this range inside of yesterday's wiki zone. That's it. We need to get out of this range. So step one, get above Friday's close. Check. Step two, get outside of yesterday's high. We're working on it. Plenty of room to run to the upside. We got 69.50 as the weekly expected move high. Means we could make that move and we still would not see this as being overbought, overextended, having moved too far, too fast, anything like that. We wouldn't see that at all. That would just be what we were expected to do. 10 minutes for the data dump. Looking at things that are down this morning, the VIX is down. China again, the dollar is down, and really that's it. So not a lot of threat or risk to the downside. Looking at what's up this morning, nat gas, Bitcoin, uranium, chips, energy, gold miners, but gold and gold miners, they're not up enough. We're looking for at least 0.5%, and they're coming up a little short. Close, I mean, 0.4 days is close enough. But that's the junior miners. We want to see the other miners come up too, right? And over a 5-day period, junior gold miners are up over 7%. That's a bit much, right? We're going to need to dial that back a little bit. So I'd be cautious of continued longs in gold and silver. I mean, it's running parabolic, so trying to call the top or call a reversal is tricky at best. Is it overbought and overextended? Oh yeah, but it can remain irrational longer than you can remain solvent. So I wouldn't try to short it just because it went up 7%. That's not a good enough reason to take a short. Tom Sosnoff did put together that aggressive contrarian trade strategy, and it does fit this scenario, but I wouldn't do it. Just because you have the strategy doesn't mean you have to execute it. If we're going to maintain this bullish bias, we need more out of these. So we want to see the Mag 7 get up in there. It would also be good to see it spread out between more than just the Mag 7 and Bitcoin. get a lot of those other sectors and the older tech too. So consumer discretionary, multiple tech between cloud, chips, communications, services, as many diversified tech as we can add to that list. And even some financials would be good. We got XLF up 0.25%, but I'm more looking at the regional banks because XLF is just too muddy, right? It's got trade desks in it, insurance brokerages. There's all kinds of stuff stuffed in there. So banks like KRE would be a better tell. Keep your eye on the 0-day flows once we get into the trading day as well. Because if we're going to get this breakout and it's going to stick, we need that push. The problem is we have the president twice today and the opportunity that he can come out and really just break things. So the threat of him possibly breaking things may be another hurry up and wait scenario where nobody wants to engage because they know he's going to be speaking, and then they sit back and wait for him to do his thing. I don't know, right? But neither does anybody else. So watch the clock. It's the best I can tell you. You got the levels. It's GTFO, as it always is. You got to get out of this box if we're going to do anything else. If you liked yesterday's trading range, then by all means, trade inside the box. Otherwise, we got to get out of this range, right? Now we've got an inverse TRB setting up. So if the market wants to break it back down, then we've got our lower levels. At the bare minimum, you've got yesterday's RTH. So yesterday's intraday low and intraday high. Catch the mid there. 68.42 old school cog line. If that breaks, we got 32 cog, then yesterday's low, then the Globex low of yesterday, 68.11 cog line. Then we break down and aim for Monday pivot, and then Monday's low, 6,800. So that's the downside. To the upside, breakout, get the 111 and the 1236 OCC. Then we run it to 6,900. And then 6,950, level by level. All right, guys, be careful, be safe, have a good day. Keep your eye on the clock. Watch the headlines. I'll see y'all tomorrow.